fifth and final module of the section devoted to the statement of cash flows, we shift our attention to the third component of the statement, namely cash flows from financing activities. In the same manner as before, we will start the module by taking a closer look at precisely which cash inflows and outflows ought to be classified as financing. Later, we will go over two brief examples of how cash flows from financing activities are actually computed, using information about the issuance of shares as well as the payment of dividends. IAS-7 defines financing activities as those activities which result in changes in the size and composition of the contributed equity and borrowings of the company. The standard goes on to enumerate the following typical examples of cash flows which ought to be classified under financing. They are proceeds from issuing shares or other equity instruments. Those other instruments being, for example, warrants, that is, options to buy a company's shares which are included within the equity section of the Statement of Financial Position. Payments to owners to acquire or redeem the entity's shares, for example, as part of share buyback transactions, which are a popular way of returning cash to shareholders and constitute an attractive alternative to dividend payments. Proceeds from issuing and outflows to repay debentures, that is, unsecured debt instruments, loans, notes, bonds, and other short or long-term borrowings. And finally, payments by a lessee for the reduction of the outstanding liability relating to a finance lease. As we noted in the previous module, IAS-7 allows preparers of financial statements a choice with regard to which segment of the statement of cash flows to use to present interest and dividend payments. These may be classified under either operating or financing activities. The standard also requires the total amount of interest paid during a reporting period to be disclosed in the statement of cash flows, irrespective of whether it has been expensed to profit or loss or capitalized as part of the carrying amount of an asset in accordance with IAS 23 borrowing costs. Let us now turn our attention to the first of two brief examples concerning the specific computations needed to derive elements of the net cash flow from financing activities. Please consider the following scenario. A company reports the following balances in respect of its share capital on the 31st of December 2015 and 2016. Its €1 ordinary share capital increases from €1,200 to a level of €2,000. At the same time, its share premium account balance also rises from €100 to €400. We are also told that during the year the company made a 1-for-3 bonus issue, capitalizing its retained earnings, followed by an issue carried out at full market price. Let's attempt to compute the cash proceeds from the issue of shares, which would obviously appear in the cash flow from financing activities section of the statement of cash flows. Let's start by displaying the opening balances of both accounts as at the beginning of the year 2016. So that's €1,200 on the credit side of the share capital account and another credit, this time of €100 in the share premium account. We can also fill in the information pertaining to the closing balances of both accounts. So that's a closing balance of €2,000 on the debit side of the share capital account and a €400 closing balance on the same side of the share premium account. We are told that during the year the company conducted a bonus issue, which is effectively a free issue of newly created shares to existing shareholders. The 1-to-3 ratio provided in the scenario means that for each 3 shares already held, shareholders received an extra or bonus share for free. Prior to the issue, the number of shares outstanding was 1,200, a fact which may simply be derived by looking at the opening balance of the €1 share capital account, where the €1 reflects the nominal value of each share. Dividing this number by 3, we may conclude that a total of 400 new €1 shares were issued, necessitating a €400 credit entry to the share capital account, with the corresponding debit being recorded in retained earnings. We are now in a position to reconcile both equity accounts by reflecting the impact of the issue at full market value, which generated a genuine cash inflow for the company. The closing balance of the share capital account is €2,000, which calls for an additional credit entry of €400 coming from the issue of 400 new shares for cash. The true proceeds from the sale of the new shares are, however, bigger, as evidenced by the growth in share premium. The missing credit entry needed to reconcile the change in this account is naturally equal to €300 and corresponds to the cash received upon the issue of new shares in excess to those shares' nominal value. Putting the two results together, we conclude that the proceeds from the issue of shares, which would need to be reported in the financing activities section of the statement of cash flows, are €700, the sum of the 400 and 300 cash credits to both accounts. Let us now turn to a second example, this time focusing on dividends paid, which, as you know, may also be reported under cash flows from financing activities. A company's statement of financial position shows the following balances in respect of retained earnings and dividends payable, the latter being a component of current liabilities, as at the 31st of December 2015 and 2016. As you can see, the balance of retained earnings grows from €700,000 to €1 million. Over the same period, dividends payable increase from €200,000 to €300,000. Additionally, we are told that the company reported net income of €800,000 for the year 2016. Our task will, of course, be to compute the amount of dividends paid. Once again, I suggest that we open up the relevant T accounts. We may start by recording the opening balances of both accounts as at the beginning of the year 2016. So that's €700,000 on the credit side of retained earnings and another credit, this time of €200,000 in the dividends payable account. We can also fill in the information on the closing balances of both accounts, so that's a closing balance of €1 million on the debit side of retained earnings and a €300,000 closing balance on the same side of dividends payable. Over the course of the year, the balance of retained earnings changes due to two factors: the recording of a gain or loss and the declaration of dividends payable to the company's shareholders. The €800,000 net income must have been transferred to the credit side of the account, bringing the total of the credit entries to €1,500,000. Transferring this total to the other side, we find that the missing debit entry, reflecting the amount of dividends declared and therefore transferred to the dividends payable account, was €500,000. Now, turning our attention to dividends payable, we may immediately post the other side of that €500,000 entry to the credit side of the account. We can see that the total of the credit entries comes in at €700,000, and an attempt to reconcile the movements in the account reveals a missing debit entry in lieu of cash dividends paid of €400,000.